Guarantees are not a significant factor. In this episode, I'm going to address IUL, Index Universal Life, versus Whole Life. The net amount at risk in max-funded IUL is far less. And this is a game changer once you understand this. And many whole life insurance agents do not get this. I want to educate you so you won't be confused by those who tout, oh, whole life is the cat's meow, the best instrument ever. Maybe for death benefit, but not for living benefits. So my name's Doug Andrew, and I've helped people optimize their financial assets and minimize taxes now for more than 4.5 decades. I started in 1974. I got my insurance license and my Series 1 securities license. And from 1974 to 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And I was a big proponent of buy term and invest the difference because most whole life insurance policies, because back then there were basically only two types of life insurance, term and whole life. Mathematically, I could prove that if you bought term insurance and did in fact invest the difference, and you got an average return that the markets were actually performing at back in the 1970s and 80s, you would outperform a whole life policy even with its tax-free accumulation. Because most of those policies were only really earning about 2.5%, 3.5%, or 4%. The biggest problem with buy term and invest the difference is most people who were told to do that never invested the difference. So they would have been better off, putting their money in a whole life policy. Well, that all changed in 1980. In 1980, E.F. Hutton, they were not an insurance company, they were a brokerage firm, and they came up with the idea of universal life, and they said, wait a minute. Whole life is good for death benefit. That's what it was designed for. That you can put in this amount of money and you can actually overpay the early years and underpay the later years, and it builds cash value and it's tax-free. And it has guarantees. And maybe those guarantees are 4%. And it means that if you pay the required minimum premium, I'm super simplifying this, that the insurance policy will not lapse. And if you pay that, they will guarantee the insurance policy will be there when you die because it was designed primarily for death benefit. That's what the guarantees were primarily there for. When E.F. Hutton came up with universal life, it was primarily for living benefits. Let's self-insure. Let's take the least amount of insurance the IRS will let us get away with and put in the most money the IRS allows as fast as they will allow, and it turns into a tax-free cash cow. Because money inside of a life insurance policy, a permanent life insurance policy, grows tax-free under Section 72E of the Internal Revenue Code. It's been that way for over a century, since 1913. You can access the money tax-free under Section 7702. And when you ultimately die, anything in there blossoms and transfers tax-free. But Hutton said, why don't we just self-insure? This is like buy term, invest the difference on steroids under a tax-free umbrella. This is what happened. We had people back in 1980 who would put in $500,000 into a universal life policy in one fell swoop. And back then, I never earned less than 11.75%, even as high as 15.5% on my universal life policies back then. But if I earned 11, I was netting 10. I had many clients who put in $500,000 and they started pulling out 10% or $50,000 a year tax-free. They're still doing it to this day. It was incredible. It was for the living tax-free income benefit. It wasn't about the death benefit. They put in a huge amount of money into a dinky little life insurance policy. They self-insured. Long story short, the IRS came in and said, what are you doing? And they said, we're not doing anything wrong. And they went to court. E.F. Hutton won. But in 1982, under the Tax Equity Fiscal Responsibility Act, they said, you've got to have a certain amount of life insurance attached to this tax-free account, or it's going to be taxable under the investment section of the code. If you want it to be tax-free here, it's got to not exceed the definition of life insurance under these sections of the code. They didn't understand totally what they were doing. How surprising is that? So 2 years later, in 1984, under the Deficit Reduction Act, it dictates the minimum amount of insurance that must be attached to the insurance account so that your money accumulates tax-free. You can take out tax-free income. When you die, it transfers tax-free. But the objective is living benefits. Now, there was this massive exodus of money leaving the banks and the brokerage firms back then because these were safer. They paid higher interest. They were tax-free. They blossomed when you die. And in 1988, June 21st, under the Technical and Miscellaneous Revenue Act, it spells the acronym TAMRA, they wanted to slow the flow. They didn't want to kill these because this is where banks put their Tier 1 assets, 30 to 40% of their Tier 1 assets, for liquidity and safety. What I just said maybe went over your head. Before I explain what I meant by that, if this is intriguing you, you ought to share this video with somebody who ought to watch this and learn more about max-funded IUL compared to whole life. And click, share, like, comment, subscribe, click the bell, because I post an in-depth answer to a financial question almost on a daily basis on this channel. And stay with me to the end, and I'll gift you a free copy of my most recent 300-page best-selling book called The Laser Fund, which is what I call a properly structured, max-funded, indexed universal life policy, okay? So under TAMRA, what happened is they wanted to slow the flow, but they didn't want to kill it because banks in the last, 10, 15 years have been paying what? A measly 1%. Every million that we collectively deposit into a bank, they pay us 1% interest, 10,000, and they turn around and loan it back out again at 5 or 6%. They're making 5 times what they're paying you using your money, OPM, other people's money. In 2008, when 400 banks went under and 900 more were on the brink of going under, there wasn't one single legal reserve insurance company who went under. In fact, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets. That's money they have to have on hand, liquid and safe in the case of a collapse or a run on the bank, so to speak. Guess where the 5 major banks have about 30 to 40% of their Tier 1 assets for liquidity and safety? In insurance companies. The multi-trillion-dollar insurance companies are the backbone of America and the backbone of the world, okay? This is why many times teachers' pensions are with annuities with insurance companies because of the safety. They weathered the Great Depression with flying colors, okay? This is where banks will take your money, turn around and put it into the insurance company and earn 4 or 5%. Again, that's 5 times what they're paying you. They pay out 10,000 on every million they borrow from us, and they make 50,000. Would you invest 10,000 on a widget machine or an employee that makes you an extra 50,000? That's called a 500% return on employment cost or equipment cost. So what happened is back in 1988, they said we got to slow the flow, but they didn't want to kill it because this is where they put their money. So TEFRA and DEFRA have to do with a minimum amount of insurance. When you talk about TAMRA, this has to do with how fast you can put the money in without sort of messing up the ability to take tax-free income, which is what E.F. Hutton designed universal life to be used for, is living benefits for tax-free income. Tax-free growth, tax-free income. The death benefit was secondary. With whole life, the death benefit is primary, okay? I would compare it to a bucket, and basically you want to create a receptacle, a container for your money, and you want to be able to put in money, but you want the least amount of insurance the IRS will let you get away with under TEFRA and DEFRA tax citations. This gives parity, meaning a 60-year-old gets the same rate of return. They can earn 11 and net 10, just like a 22-year-old athletic marathon running female, or even an 80-year-old. I had an 80-year-old friend who had 3 blocked arteries, adult onset diabetes, a prostate cancer episode. But we were able to squeeze down his death benefit on his universal life so that he could earn 11 net 10. Because you're able to squeeze down the death benefit because it gives parity if your objective is tax-free growth and income. So you might put in $500,000. If you're 60 years old, the minimum death benefit would be $1,250,000. You can buy way more life insurance than $1,250,000 with $500,000. That's not the objective. That's the least amount of insurance under TEFRA and DEFRA. TAMRA came along and said, oh, you can only put in 100 grand a year, 100,000 the first day of the first year. And finally, 4 years and 1 day later, you can put in the entire 500,000 in this example. There's nothing magic about 500,000. I'm just using it as an example. If you comply with TEFRA, DEFRA, and TAMRA, this bucket of 500,000 can double to $1 million. $1 million can double to $2 million. $2 million can double to $4 million. $4 million can double to $8 million. I actually have clients who have done that. They started out with 500,000. They now have $8 million tax-free in their bucket, generating between 640,000 to 800,000 a year of tax-free cash flow if they want. The spigot on the bucket is the cost of the insurance that the IRS says has to be there in order for it to be tax-free. But a maximum funded indexed universal life is the only policy when it's designed this way where the cost of insurance gets cheaper as you get older. Have you ever seen an insurance policy that gets cheaper as you get older? This is what a lot of whole life agents don't understand. If I put in 500,000 and the original death benefit required was $1,250,000, 500,000 of the $1,250,000 is my money now. The insurance company is only charging me on that spigot for the remaining $750,000. If I earn rates of return like I have in 7.2 years, the $500,000 doubles to $1 million. Now the net amount at risk is only $250,000. The spigot on the bucket is getting cheaper. When the $1 million doubles to $2 million, $2 million is twice as much as I had 7.5 years earlier, but it's more than the death benefit. Why in the world do I need guarantees that my life insurance won't lapse in a whole life policy when I'm self-insured? E.F. Hutton designed universal life so you would self-insure. So let's do the math here. Maximum funded whole life versus universal life. So let's do apples to apples. Let's take a 65-year-old who 5 years earlier started to pay the maximum amount allowed. Now, frankly, in a universal life, you could put in 100 grand a year for 5 years. Whole life, you have to spread it out over 7 years, and that's why it doesn't perform near as well. The minimum death benefit, if you started this at age 60, is $1,250,000 under TEFRA and DEFRA. So you put in 100 grand a year for 5 years. Now you have $500,000 in there. It will have grown with interest, but I'm just going to simplify this. This $500,000 of cash value that was funded over a 5-year period, you could do that in your whole life policy too. But it would take you longer than 5 years to get it in there. Let's just assume you could get it in there. And let's just take a snapshot in time and say, okay, we have $500,000 now of cash value in a whole life policy, and we have $500,000 in a universal life policy. What's the difference? Well, I have found that most whole life policies, unless it's variable and you put your money at risk out in the market, you might be lucky to earn 6 and net 5, okay? The only policies that ever touted years ago 8% only netted you 5.99% by the time you were 95 years old. I was netting what most whole life was grossing for years on my universal life. If you're earning 5% on 500,000, okay, that means in 14.4 years, $500,000 is going to grow to $1 million. If that is part of the death benefit, then the net amount at risk is only the remaining $250,000 because $1 million of it now is your money. The insurance company's net amount at risk is all they're charging you for. You are self-insuring. But do you know what I've earned on my universal life average? 10.07. 10% on 500,000 means that it's going to double every 7.2 years. So in 14.4 years, instead of having $1 million, I'm going to end up with $2 million in my universal life. I've seen it over and over and over again. Now, wait a minute. If in 15 years, I've had many clients that the death benefit that was originally $1,250,000 in this example, now is totally gobbled up by $2 million of cash value. TEFRA and DEFRA says the death benefit has to stay ahead of it by at least 5 percentage points. So the death benefit now grows to $2.1 million. The insurance company is only charging me for the last little 100,000. That's a minuscule portion of the interest that I'm earning on $2 million because I've self-insured. What am I worried about guarantees that guarantee the policy won't lapse when I have $2 million of cash value, which is far more than the death benefit. In fact, it caused the death benefit to go up because I have self-insured. The net amount at risk is 1/20th what it was when I was 15 years younger. In other words, the older I get, the cheaper the insurance becomes on universal life when it's maximum funded. So stop talking about whole life has guarantees, because under the new section 7702, it looks like those guarantees won't be 4% anymore because whole life policies are complaining they can't afford it with the low interest rates. It might go down to 2%. I don't worry about guarantees because I am self-insured in as little as 15 years. I don't need guarantees because I now have the money in my policy tax-free, far greater than the original death benefit. And I can prove this to you many different ways with different examples on clients that we've helped for years. If you want to read examples of this, let me show you how you can read and learn, watch and learn, or listen and learn. So if this is intriguing you, I call a max funded indexed universal life, structured correctly and funded properly, the laser fund. You can own an indexed universal life insurance policy, but if it's not structured correctly, or if you have not funded it to the maximum amount, it would not qualify to be called a laser fund. Laser means liquid asset safely earning returns. And so I wrote a book about it. It's 300 pages, but it's actually 2 books. This one is 200 pages, 14 chapters with all the charts and graphs explaining max funded indexed universal life. If you learn more by stories, you flip it over and read this one, 100 pages, 12 chapters with 62 actual client stories of how max funded IUL, the laser fund, can be used for retirement, college funding, working capital for business, real estate management, emergency funds, estate planning, on and on and on. It's the dream solution for many financial goals. I call it a financial Swiss Army knife. How do you get your free copy? You can claim your copy by going to laserfund, laserfund.com, click on the link below, and contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll pay for the book. I'll fire out a copy to you. And if you like to listen and learn or watch and learn, there's different opportunities for master classes online and what have you. And you can join us for educational webinars. This is about you and your brighter future. And so I would love to gift you a copy of this, and here is to your brighter future.